Thank you, Chair, for the opportunity, and the Vice Chairperson, the Executive Secretary, esteemed governors, and all the distinguished guests. We thank you for the privilege to present to you the initiative of the African Union that the African Peer Review Mechanism has been working on together with the African Union Commission. We've got a presentation that I would appreciate if it is projected before I continue. Thank you. So this initiative that the APRM is embarking on, it's in support of our member states of the African Union in the area or in the field of credit rating agencies. So our participation in this meeting is that we seek to brief you on the Assembly decision that has been adopted by the AU Assembly to support member states in international credit rating agencies. But basically, because it relates to the theme of this meeting in relation to monetary policy and financial stability, and also to solicit your guidance going forward on the document that we have circulated, the draft policy framework in this regard. So just to lay the background of this initiative, it is a mandate that has been discussed and proposed in different platforms, but it was formally adopted as an Assembly decision in January 2017, instructing or directing the APRM to offer support to member states in that regard. So to lay the background of the rationale behind the decision, so I'll just present to you some statistics behind this initiative. So on the screen there is the current dynamics or the current situation in the credit rating in the whole of the continent. So for the total of 32 rated African countries, we only have 4 countries that have got an investment grade, and only Botswana being still in the A class rating or status, and 2 of them being Morocco and Mauritius, and the 4th one being South Africa, which has already lost its investment grade with 2 rating agencies. So the bulk of it, if you can see, it's in the B class, which is defined technically as a substantially high risk countries to invest in. And that is colloquially referred to as a junk status. And Mozambique is already in default. And if you look at that graph, it presents the economic growth over the time when South Africa was rated, the first African country to be rated in 1994 and up to now. So you can see that the economic growth has been significantly positive, above 3.6%. But over these years, that has not been reflecting in the credit rating that the African countries have been receiving. So still, most of them are still lying in the junk status category. So here, just to take a snapshot through those 4 countries that are the highest performers in terms of economic growth in Africa over a stretch of about 10 years. You can see that with a growth rate of almost over 6% in a stretch of 10 years, the rating activity has not changed. It's still in the junk status. And also here you can see that looking at the statistics of the number of upgrades and the number of downgrades, the number of downgrades have been more pronounced than upgrades. And also the negative outlooks, which is giving a direction of the impending rating action before it happens, they have been more by far compared to the positives, This is statistics of total rating activities in Africa countries up to December 2018. So you can see that as we come to 2018, the gap between the upgrades and the downgrades have been more pronounced and is been widening. So the argument has been that if the African countries and the bonds they issue have been classified as substantially risky, why is investors still so much interested in them? Because if you look at the bond issuing statistics, you can see that almost all of the sovereign bonds issued, they are oversubscribed. So this is just a few of the countries that have issued bonds, sovereign bonds in the recent future. You can see them oversubscribed 3 times, and for Ghana it's even more than 7 times. And here we have just put a cutout from different newspapers of countries that have issued statements and showing their displeasure with the contact of rating agencies on in their situations on the continent. And the main issue there is the lack of proper consultation or inadequate consultation as far as some risky factors in certain areas are concerned. And adding on to the globally known weaknesses and criticism that have been leveled against rating agencies, specifically their involvement in the crisis in 2008, there have been a challenge on the methodological biases and deficiencies as far as African countries are rated, because the economic growth in African countries is somehow been dismissed as fragile growth. But still argue that if the growth is fragile and economic growth is a product of different factors that is pulled together to bring up positive growth, then there must be some merits that is worth considering. And to some extent, there have been a feel of aggressiveness against African countries to some extent, because looking at the statistics of other countries that are in other continents that are going through a conspicuous crisis, they are still maintaining better ratings far beyond that are allocated or assigned to African countries. And this has had a direct bearing on the fiscal policies and the fiscal dimension of the country's fiscus. Because when a rating or a country has a poor rating, it has a direct implication on the cost component of servicing debt. So here, allow me the courtesy of using a case of South Africa, which is the country in Africa which has the highest number of rating activities, and was also the first country to receive a rating on the continent. This is just the bond, sovereign bond dynamic for different bonds, the 3 months, 10-year, and 30-year, when South Africa was downgraded into junk status in 2017 by the 2 rating agencies, S&P and Fitch. You can see that in a total of 12 days, the bond had increased in cost with those percentages there in each of its tenures. And also looking at the trend over the time, you can see that when the ratings in the bars were increasing, the interest rate was also decreasing. So this proves that the dynamics in the ratings have got a direct implication in the sovereign bond servicing cost. So here is the key areas that APRM has been looking at to offer support as far as credit ratings are concerned, especially the issue of preparing countries for ratings, because in some cases countries are not well prepared to engage rating agencies, or sometimes they lack the capacity to do so, and also helping to determine the impact of the credit rating when it changes. And a number of countries in Africa also doesn't have a proper regulatory system to regulate the operations of agencies in their jurisdiction. And during the rating exercise or post-rating, they issue their rating reports, which has got some recommendations that need some alignment into the national policy. So this is part of the document that we have circulated, the draft policy framework. So I'll just brush through some of the key sections that we have in the framework. So the background here just highlight the mandate, the legitimacy of the mandate that we have from the Assembly, and also the purpose of the framework, which is to provide strategic and operational support to member states in the pre-rating preparatory phase, managing the rating exercise and the implementation of post-rating recommendations is aimed towards promoting the continental policy convergence. And these are the objectives, but key amongst those is to equip and capacitate the liaison team that engages directly with the rating agencies when it's undertaking the assessment exercise, and also to give government support into the implementation of recommendations. And here is the operational and oversight mechanisms that we are proposing in the framework, but these mechanisms will be implemented through the existing institutional framework of the APRM. So it's a matter of extending the magnitude of the current exercises to include the support on member states in the area of rating agencies. And already the APRM has constituted an ad hoc committee specifically for this, which is constitute different experts from the continent. And I have the pleasure to announce to you that, or to inform you that we've got a number of central banks that we have engaged in this process, who are part of the ad hoc committee. And resources, we've got the budget allocation that has been approved already by the Assembly, which is the program budget specifically to implement this decision. So the role that we envisage that AACB will play in implementing this decision is to provide support in the development of a more continental regulatory framework. And also we envisage that we will be producing an annual report which outlines in summary and review the operation and performance of regulations.
Can I intervene for a second? Yeah. You are acting as rating agency, rating advisory for clients or for central banks, etc., right? This is what you're proposing, rating advisory services?
It's part of the function we are proposing.
Rating advisory service. And you've sent to all central banks directly, right?
To some of them, not...
Some of them, okay. So can you give us just your conclusion, because here we are behind time, and of course, since the central banks have received your proposals, this will be reviewed by the required relevant divisions in our central banks. So if you can give us what's your conclusion in terms of this presentation, because we don't have except a few minutes left.
Our conclusion was that we just seek your advice and guidance if there is any need for some considerations going forward is part of our consultation coming up with or enriching and enhancing the policy framework that we are putting together.
Right. And you have a track record before on this matter?
Yes, yes.
With which countries?
We intend to already show you this is the milestone of what we have already embarked on, and we intend to embark on a consultation in a number of countries that
You intend?
Yes.
Okay. Thanks. We will review the documents when we go back home, and it will be to each central bank to see what they want to do, right? Because this does not need a collective decision, you see. Correct?
Thank you.
Thank you very much.